Hello, and welcome to this video on inventory costing and inventory ratios using PepsiCo's 2019 annual report. You'll notice that on PepsiCo's balance sheet, all inventory is summarized in one small line. There's $3.38 billion of inventory at the $3.338 billion in inventory at the end of 2019, about $3.1 billion at the end of 2018. If you want to find more inventory information, including the methods in which it's used to cost inventory, you'll look at the note on significant accounting policies. Inventories are valued at the lower of cost or net realizable value, which is what your book calls the lower of cost or market. Meaning, if it costs you more to make the inventory than what you can sell it for, you can mark it down. This doesn't happen very often. So mostly you just take the cost, and the cost is determined using both the average cost method, the first in, first out method, or FIFO, and in limited instances, the last in, first out method, which is the LIFO method. Note 15 of PepsiCo's 2019 annual report 10K has supplemental information on several financial statement items, including inventory, because PepsiCo makes its inventory that needs three types: raw materials and packaging for the goods that it's going to make of 1.395 billion, about 1.4 billion, work in process of 200 million, very small amount. That means it started into production but not finished and ready to sell. Most of inventory is finished goods, or 1.743, which you can sell to your customers. Because PepsiCo uses LIFO for a small percentage of its inventory, its LIFO reserve, which is the ending inventory under FIFO minus the ending inventory under LIFO, is insignificant and not disclosed. Your book talks about the LIFO reserve that a firm must disclose if it uses LIFO. But again, in note 15, there's like a little footnote here that says only 7% of 2019 inventory is costed using LIFO, and the difference between using LIFO or FIFO is very small. PepsiCo sells its inventory pretty frequently and turns it over. That might be one reason. Inventory turnover for this ratio will need this year's income statement and this and last year's balance sheet. It's a liquidity ratio measuring the short-term ability of the company to pay its debt. Sales of inventory usually lead to collection of cash, but sometimes you sell inventory on credit and then you collect the cash. So if we look at PepsiCo in 2019, on the income statement, cost of goods sold is $30.1 billion. To get the average inventory at the end of this year, $3.338 billion plus $3.128 billion last year. Add them up, divide by 2 to average them, we get $3.233 billion. Inventory turned over, meaning on average you sold your inventory 9.3 times in 2019. In 2018, you sold your inventory on average 9.7 times during the year. Turning inventory over faster is better. So because in fiscal 2019, PepsiCo sold its average inventory 9.3 times, higher inventory turnover indicates more efficient inventory management, other things being equal. If sales are profitable, turning your inventory over many more times means you have more net income. Using inventory turnover, PepsiCo was less efficient. It turned inventory over fewer times in 2019 than 2018. A way to make this easier to understand is to convert the inventory turnover into days of inventory, or days in inventory. Take 365 days in a year, divided by the number of times that inventory turns over in a year to get days in inventory. So you need the inventory turnover ratio calculated on the prior slide using the current year's income statement and the current and prior year's balance sheet. Like inventory turnover, it's a liquidity ratio measuring the short-term company ability of a company to pay its debts. However, it's interpreted in the opposite direction. Higher inventory turnover leads to lower days in inventory. Lower days in inventory means you don't keep too many days on hand and you are efficient at managing your inventory. So having inventory turnover 9.3 times in a year means on average you have 39 days of inventory on hand versus inventory turnover of 9.7 times a year means on average you sell your inventory every 38 days. So PepsiCo sold its inventory on average every 39 days. It took a day longer than the 38 days to sell average inventory in fiscal 2018. PepsiCo was slightly less efficient, took a day longer to sell the inventory in 2019 than in 2018. Please feel free to use this presentation as a review before looking at other companies' annual reports for the weekly discussion board. I will also post a copy of the PowerPoint slides in Moodle for you to look at. Good luck and get started, Jaspers.